get a sense of how things are going to change, because I think, we were discussing a few weeks ago how this year's seen some absolute stellar earnings, and that's unlikely to be repeated. So how does the risk-reward ratio alter next year?
Well, I think the irony at the moment is that you have both a divergent policy between the two biggest economies, and both markets, the US and China, have got credit spreads widening. So the paradox now is that that really does change risk premium for equities, and you've seen the VIX, you've seen volatility in the United States picking up, and similarly in China as well. So for two of the biggest markets in the world, you're really going to have to look at returns per unit of risk now. It's not just a straightforward...
How do you do per unit of risk?
It's a Sharpe ratio, and all of the last 12 months has all been one way. Earnings growth, very good GDP numbers, economic surprises. But this time around, it's going to be volatility. And I think the 12 months now going forward are going to be actually one of the most difficult periods we've seen in the last 2 decades. Credit spreads widening so quickly after recovery has not really ever been seen before.
You mentioned about the divergence that we're seeing from the Fed and the PBOC. That's our question the day today, is that how is that really going to impact assets for next year?
So I think in this part of the world, we're in a slow, grinding decline in China's GDP numbers. And I think the paradox now is, with property in China accounting for somewhere between 23% to 29% of GDP, you can only really hope that the actual slowdown is a very gradual one. So in this part of the world, I'm afraid to say, earnings numbers are still going to be heading down. And it's been the best performing style in China for the last 12 months, a scarcity of growth. In the United States, I think it's all about the market reaction or testing of the Fed to how far they can actually raise rates. Looking at the flat yield curve that we've got in the US already and the credit spreads widening, it looks like it'll only be 2, maybe 3 at the most. At that point, the Fed gives in. So at some point in 2022, you're going to have both central banks perhaps going on to an easing or on a hold cycle, both in China and the United States. A very quick cycle, actually, already. Tightening policy and loosening it really rapidly as well.
So, Sean, David here, what does it mean then for Chinese equities next year? I mean, they've been cheap, relatively speaking, for most of this year, and we were waiting for a trigger, and that trigger might have been a triple R cut or some sort of sign from authorities. Do you think this serves as a catalyst for 2022?
For me, I think we're going to stick very close to the quality, the consumer stocks in China, and also in the productivity plays. I don't really see any divergence in that sort of strategy for the next 12 months. I think that perhaps the best thing that may happen for equity investors in China is that the inflation rate starts to decline. We're already seeing a peaking in PPI and thermal coal prices, and that'll be a nice tailwind for the A-share market. But really, the good news is that the balance sheets of corporates in the CSI 300 and in the mainstream Hong Kong markets are actually really good outside of the property sector. So, playing that sort of wholesome theme of balance sheets is actually probably going to be the best rewarding strategy in the Hong Kong-China space. You
mentioned the A shares might enjoy this boost from a triple R cut. What about when it comes to Hong Kong?
Well, here, the irony is that the 2 major risk factors that drive Hong Kong is really the rate cycle in the US, which may actually turn out to be a bit of a sort of damp squib, which is where I'm going for, and also the RMB strength. So ironically, Hong Kong should actually be experiencing a floor in equity prices at the moment. The irony is that when you have such a savings bias in China, currencies tend to be strong, and that's exactly what you're getting in China. Paradoxically, the RMB is strengthening and wants to strengthen, and that'll be actually good for Hong Kong equity risk premium.
We talked about Indonesia. I think just 12 days ago, we were at a record high for that one. We've come off a little bit, but you're still optimistic.
I think it's a story that's sort of been not really heard by investors. I think in a sense you've got the best ever balance of payments running through Indonesia at the moment. Record current account surpluses, record trade surpluses, FX reserves are close to record highs. If you remember back in 2013, 2018 when we had the taper and the Fed was also engaged in raising rates, this market and the financial system was under incredible stress. And I think at the moment it's very, very insulated. And the normal Achilles heel for Indonesia has been a higher inflation. It's actually been relatively subdued. So the sort of factors that would normally cause Indonesia to underperform are actually reversing. And you've got this big boost from the commodity cycle occurring at the same time, and a decent vaccination rollout as well.
So you think Indonesia stands out among just ASEAN, which people are turning a little bit more constructive on?
Yes, unfortunately, the
Yeah.
vaccine rollouts in Philippines and in Thailand have actually really delayed the recoveries there, and probably they're only second half stories for next year. But Indonesia's really got the economic momentum now, and the reopening there can unleash quite a lot of pent-up demand, as we've seen in the US and in Europe for the last 9 months.
How interested, Sean, are you in the whole digitalization in ASEAN taking place? It's, we see these IPOs coming through. We were interviewing the Philippines' first fintech, just first unicorn yesterday. It's quite something. Are we missing the boat?
Well, I think the big story, there are two really stories. One is that ASEAN has a lot of ability to scale. So for these type of business models, the digital models, that's actually really perfect place to enhance returns. And the second is, what we've learned from China is digitalization brings about disinflation. You get a long-term secular drop in the inflation rate because, essentially you get large productivity gains being built into the economy from digitalization. So if you look out 3 to 5 years from now, actually these economies in ASEAN won't actually have any inflation problem at all. In fact, perversely, they'll be having a low inflation regime.
We'll hold you to that.
Yes, I'll come back in 5 years and let you know.
But I mean, some of the plays that one would have thought would benefit from that have seen just a massive collapse, right? So you have Grab, for example, that IPO in the U.S., and then Bukalapak, even Paytm, for example, is that play over in India. I mean, yes, the trend is there, but does the market seem too richly valued on those plays?
I think initially they have been priced for perfection. They couldn't really look to actually beat a lot of their numbers, particularly as we've had these sort of serial lockdowns and restrictions. Yeah. I think the issue perhaps is that in the background, people are looking 12 to 18 months out where credit conditions may be tight, and actually that these companies may find themselves facing risks of refinancing. That's going to be probably the issue for some of these IPOs and the more venture capital linked type of companies, is that credit conditions may not necessarily be as amenable as they are at the moment.